South Korean chipmaker SK Hynix reporting bumper quarterly results, but still missing expectations for even loftier profits and sales. Second quarter operating profit jumping sixfold on year to a record $42 billion. Sales jumping threefold to $50.7 billion, also falling short of projections. Our shares plunging almost 19%, paring those losses to end down 9.6%. The stock losing more than half its value since hitting a record high last month, although it's still about 115% so far this year. The second largest memory chip maker saying demand remains strong for AI memory chips, looking to at least $31 billion in capital spending this year. Company executives say they are signing long-term contracts reflecting confidence that demand will outpace supply until at least 2030. A brutal day for South Korea's chip giant. Samsung Electronics also tumbling more than 5%, and the broader Kospi plunging for a second straight session, diving as much as 12.6% before paring some of those losses to close down 6%. The two-day rout wiping around $2.18 trillion from Seoul's equity market. The finance minister apologizing for an introduction of single-stock leveraged ETFs, which he now says had not received sufficient consideration. But he has promised a review of measures to stabilize the market. Japanese equities and chip stocks not spared either. Memory chip maker Kioxia down 13.85%, extending a losing streak to a fifth session and bringing losses over this period to about 40%. Heavy losses as well in Tokyo Electron and equipment maker Screen Holdings. And joining us to talk this through, we have Mr. Rolf Bulk. He's head of Semiconductors and Infrastructure at Futurum Group. Thanks for coming in and joining us this evening.
Thank you.
Now, those figures, right, sixfold in operating profit and threefold rise for revenue. In any normal market scenario, you could miss a little bit. They might brush that off, but we're far from normal here.
Yes, exactly. Thank you for having me. And you're exactly right. 42 billion in operating profit. Samsung earlier this month also record profits. Now the most profitable chip company globally. So these are stellar results by any metric. However, given the current market sentiment and nervousness of investors around the AI trade and these exacerbating issues of the single stock ETFs in Korea, any disappointment is taken to be a major negative. And that is what we've seen today with the stock down 20% before recovering a bit throughout the day.
We'll get to why there's this, I suppose you can call it crisis of confidence or nerves. South Korean financial regulators and head of the central bank are meeting today to look for more measures to stabilize the market. You talk about those leveraged, those ETFs. Could they, he's admitting now that those could have been better considered. Could anything else be better considered at this point for South Korea?
Well, the single stock ETFs, that was a key consideration. And these companies, SK Hynix, but Kioxia in Japan as well, SK Hynix is up around 500% over the last 12 months. Kioxia is up well over 1,000%. So these are enormous rallies, and it is very normal that stocks take a bit of a breather after these rallies. However, what we've seen over the last few months is that driven by that exuberance, retail investors have plunged into these leveraged ETFs. And once that construction is set up and stocks then begin to decline, those positions need to be unwound, which creates this shortfall. Now, that is the biggest technical issue. Apart from that, there's also general nervousness around the market, but those are more fundamental factors, I would say, rather than technical factors that could have been prevented in Korea.
Let's look at those fundamental factors. So it could be worries about demand fading for these chips. It could be supply being met by much cheaper Chinese alternatives. It could be worries about how all this spending is being funded. How would you describe these concerns? How would you rank their relevance?
Yes. Well, a major concern in the market is that clearly these are investments that are unprecedented. We're talking about more than 10 trillion in spending over the next 5 years on AI data centers. A lot of that money, a lot of those investments ends up with companies such as NVIDIA. And what we see now is that NVIDIA is beginning to fund investments in AI data centers. So they've essentially guaranteed for an amount of 250 billion an investment that OpenAI plans to make in a big data center in Ohio in the US.
So essentially, it's investing in its own customers.
Essentially, it is a circular type of dynamic where NVIDIA is guaranteeing the investment of OpenAI, and OpenAI then turns around and buys chips from NVIDIA. Now, this is not necessarily something that is going to create a negative impact for investors. If demand for AI compute continues to be high, such as it is today, there won't be any issue. However, if demand for AI over the coming years decreases, then that risk that was previously on OpenAI is now shifted to NVIDIA and its shareholders.
The fear that future demand may not be met, how justified is that?
At the moment, there is no indication in the market, or from what we can tell, that demand for AI workloads for compute is decreasing. Last week, Google, which is one of the major hyperscalers with very good visibility on demand, increased their CapEx budget for 2026 by 15 billion, now around 200 billion of spending that they expect to do in 2026. And that is a real good indicator for sustained demand for AI, at least for the foreseeable future.
So if we look at these varying concerns, so demand that may or may not flag after a large-scale spending, supply that may be met by Chinese alternatives, and the way in which, whether it's circular funding or by debt that is perhaps improperly leveraged, which would you think is most threatening right now? Final question.
Well, China, I think, is a topic that investors are nervous about. The circular financing is one thing, but we also have increasing competition from Chinese companies such as CXMT, a memory manufacturer that IPO'd a few days ago. That is a direct competitor to SK Hynix, to Micron, and to Samsung. And the fear in the market is that if CXMT and its peers in China manage to become more competitive, that will disrupt the current dynamics and profitability. I do not think it will go that quickly. I think they are several generations behind in terms of performance of their chips, but it is something to keep a very close eye on for investors.
Final question, sorry to cheat. Short question, short answer. This report by our correspondent earlier, a possible Chinese manufacturer of deep ultraviolet lithography, how significant is that?
Yes, so DUV, deep ultraviolet lithography, is one of the tools that you require for chip manufacturing. Currently, there is only one supplier, ASML, that is, or effectively only one supplier, ASML from the Netherlands. So if a Chinese company manages to manufacture those tools themselves, that would enable the Chinese ecosystem to become much more competitive versus a Hynix, a Samsung, and a TSMC. So it is important, but ASML has worked for decades to bring these tools to market. And it's going to take years before the Chinese are competitive with their own tools compared to what is currently being offered by ASML.
So there's a risk that's in the long term magnified by current nerves from investors.
Absolutely.
Thank you for coming in to explain this to us. Mr. Rolf Bulk from Futurum Group. Thank you.
Thank you.